welcome everyone here and to welcome the group of three people on to my right, particularly Gordon Menzies, who will present the paper. Gordon and I go back an awfully long way. He did your undergraduate work in Sydney before graduate work at ANU, is that right? Or both undergraduate?
New England.
New
University
England
of New
first. Then master's degree at ANU, which is the place I visit whenever I go to Australia. And then to the Reserve Bank, where we first met when I was visiting Australia and Gordon was still at the bank. Then he came to Oxford as a mature age PhD student to be supervised by none other than Donald and myself, many years ago now. And since then, Gordon has had his second career teaching macroeconomics at the University of Technology, Sydney, a very lively and interesting university, which now has one of the most interesting buildings in Australia.
Yes, it does.
In which he works. By, why can't I remember the architect?
Frank Gehry.
It's a Gehry building, and a really wonderful building to work in. But Gordon is embarking on his third career now, a bit like me, macroeconomists who think later in life they ought to turn to the study of ethics. And Gordon and I have been discussing these problems, as has Gordon and Donald and Tom, for a number of years. He's come here as a visitor to the Martin School, connected to Peffham, and is here most of this term and for the beginning of next term as well. Donald and I know each other from many years, and many years.
Don't say how many years.
It's a long time. And Tom and I don't know each other, and it's a big welcome to Tom Simpson to come and join us here tonight. That's enough. Off you go, Gordon. Thank you very much.
Okay. Well, let me just begin by thanking the Martin School and St Anthony's, and on a personal note, David himself, for allowing me to come to Oxford and supporting my visit here. And on behalf of the three of us, I'd just like to thank you for the opportunity to present at this meeting. So we're going to talk, or I'm going to talk, and everyone will chip in at various times at the end, about restoring trust in finance and why that might be necessary and what might be involved in that. So I'm just going to talk about a number of things here. I wanted to first of all discuss how I learnt about some of the opportunities that come our way because economic theory fails. When I started at the Reserve Bank of Australia, I discovered that certain things that should work in theory don't work, and they create opportunities for making money, and that these create temptations for financial institutions to mislead their clients. It will be no surprise to anybody here to make the statement that financial firms have a bad reputation, but I want to contrast that with the reputation that they had before the suite of reforms known as the Big Bang, and look at the departure, I beg your pardon, of the gentlemen bankers. That's not an inclusive term, I apologise, it's a historical term for the situation in the city before the Big Bang. I want to talk about how that change led to a loss of moral restraint in some areas and how that might be costly. The normal economist's way of dealing with what we might call difficulties in motivations in people is to introduce competition policy where the moral motivations don't matter as much. So I want to talk briefly about how feasible and effective that is in finance. I'll overstate my case there a little bit. I guess I think that it is more difficult than in other industries, but maybe not impossible. But finally, to the extent that it is difficult, it suggests that we ought to turn to addressing the moral motivations of bankers explicitly. So in terms of the logic of my argument, the three last points are really the key ones. Something was lost in the transition from old style finance to new style finance. Does competition policy work for banking? I'm going to overstate my case and say not very well. No, it doesn't. And finally, that then implies that we do have to think about what kind of a moral atmosphere exists in finance. So let me go back many years to when I arrived at my first job at the Reserve Bank of Australia. I arrived, as most graduate students do, with a suite of models in my bag, and I began to try and put them to use. Somewhat mischievously, the person who was my boss in the research department, David Gruen, who you would know, David, came up to me and suggested that I should just confirm something. There's a theory in economics called uncovered interest parity, which I'll just explain in a moment. He gave me some data and suggested that I just sort of confirm that it works. So any capital gain that you obtain by holding a currency asset in a well-functioning market ought to be offset by an interest differential loss. That's because if that's not the case, then people should be trading currencies until that is the case. So in expected value terms, you ought to expect that the expected exchange rate change ought to be offset by an interest differential. Now then, if you add to that the standard fare in economics of rational expectations, and you say that change in the exchange rate, little e, that could be any kind of expectational mechanism. If you say that that's actually mathematical expectations and it has the property that the expected change equals the actual change, that's the change in the exchange rate t plus 1 there, the actual change up to a white noise error, if you're prepared to make those assumptions, then you can make the end of the third line equal the end of the first line. Just set them equal to each other, and hey presto, there you have it. Uncovered interest parity. The future change in the exchange rate equals the interest differential. Macro modelers love this. Just drop out the error term because it's 0 on average and just plug it into the models. Now, I can of course write that second last line as I can just put a beta in front of the interest differential and just say beta equals 1. Now, it was somewhat mischievous of my boss to suggest that I go away and confirm this, because when I tried to, I found, along with every researcher for every currency in the whole post-float period, that this is a disaster and it doesn't work at all. The coefficient on beta is overwhelmingly significantly less than 1, and it's sometimes even significantly negative. What does that mean? Well, it means two things. On a theoretical level, it means that capital losses on currencies don't wipe out interest rate premium. That's what it means theoretically. Practically, this gives rise to what's called the carry trade. If you give me your money, I can just go around the world and find the highest interest rates, pop it into those currencies, put it into those interest rate bearing accounts, and on average, I'll make money and send you some money as well. It is, however, on average, in the foreign exchange market literature, it goes by the colourful name of the peso problem, and you can see it illustrated on the bottom there. Imagine that you held a currency that was on an exchange rate peg and it was about to collapse, but you didn't know when it was going to collapse. What the regression I just showed you and the coefficient less than 1 illustrates is that taken over a very long period of time, the interest premium that you earn on holding that currency before it collapses at some unspecified date in the future is more than enough to compensate you for the collapse. That's what that regression result tells you. However, woe betide you if you are sitting there on the edge when the currency collapses. Woe betide you as a trader. Woe betide you if you're a financial institution heavily exposed to that. Woe betide you if you're an economy that relies on a financial institution or a cluster of financial institutions that sits there and is about to be bankrupted. David mentioned my doctoral work. I worked with him on the Asian financial crisis, where the Indonesian rupiah depreciated by 75% in 1997, which is not a nice amount of depreciation to have to deal with from any point of view. So, what did I learn? I learned that as I entered the economics world as an actual professional and not simply as a theorist, that theory without practice isn't enough. The real world throws up strange ways of making money which are inconsistent with the theory. Some of these ways, and this is a crucial point I'll come back to, involve making small amounts of money for a long time, but being subject to risking a lot of money without warning. And I didn't understand until I worked through a list the temptation that means for financial firms to mislead clients. Because of course I can collect your money and put it in the highest interest bearing place, and then I cannot really emphasise to you how much is at risk when finally the currency crashes. And there are a number of strategies like that. All right, as I said earlier, I don't think anybody will be surprised at this statement. Their reputation is so bad that people can even make films about it. You know, if you'd said to me 10 years ago that you could make a lot of exciting films about banking, that would be hard to imagine, but now you can. Banking involves trust, or it ought to. The Latin origin of credit is credo, I believe. Financial institutions create all sorts of special links between parties, and bankers can only satisfy everybody by fulfilling promises. Central to this is the fiduciary relationship, but unfortunately, trust means different things to different people. You can have weak trust, or what's called encapsulated interest, where agents will fulfil their promises and obligations only when it's personally rewarding for them to do so. And then you have what you might call strong trust, where agents always fulfil their promises and obligations even when it's not personally rewarding. Unfortunately, I think it's fair to say that the public now only expects weak trustworthiness from the banking sector. Something else that's been interesting about the global financial crisis and the aftermath is that this has reached a focal point of anger with bank bonuses. Now, this anger tells us something that's important for us, especially as economists, and that is that fairness matters in some sense. For the people in this room who are highly educated, I'm sure you're all aware that making a statement like that is a contested one, because people will contest what is meant by fairness and what the ultimate source of meaning for fairness is. So you get a number of views. Unfairness can be seen of as a lapse of justice by the standards of the categorical imperative, Kant's idea, or derivative from Kant, the claims of the original position Rawls's idea. One of the commentators on the global financial crisis is the Archbishop of Canterbury. He's obviously speaking from a theistic point of view, so even though he mightn't say it explicitly, justice would be seen within a theistic framework of moral obligations. Or there are people who regard moral claims as illusions. People believe them, and so it's important to describe them simply to understand how these deluded people operate, but they're not real in any sense. So this would be the view that just as a client doesn't like being fleeced by their banker, a mouse doesn't like being caught by a cat, just as you wouldn't say neither the cat nor the client neither the mouse nor the client like what's going on, but you don't go and say to the cat, you're doing something really wrong here. We won't pursue that last one in this talk. Bonuses are interesting from another point of view. The question is whether bonuses have corrupted bankers. Now, there's considerable academic evidence of motivation crowding out there in general, and this is actually a general point for economists, because for a long time we've been encouraging people to use incentives. We say incentives matter, and often we encourage the use of financial incentives. But it's a big deal if the use of financial incentives is not neutral with respect to the amount of virtue in a particular situation. If the use of financial incentives evacuates virtue, then this is a big deal. Now, many of you would have heard the famous example of the Hafer daycare centres. They were having a problem with people arriving late to pick up their kids, so they introduced a fine, and the degree of late coming rose. The explanation offered by the authors of this study is that prior to the imposition of the fine, the whole problem was seen in the moral frame, and people thought arriving late was bad behaviour. Once there was a fine in place, it was seen through an economic frame, and suddenly there's a price there for looking after my kids, and the question is, am I prepared to pay the price? And so the moral claim is evacuated, and people start to see it in a market frame. There are many other examples of this. I'll just give you one more. Something called the dictator game. Many of you will be familiar with it. I simply say to Tom, I've got £100. I'm the dictator in this game and I offer a division. The interesting thing is why I don't offer, I'm a dictator so he can't have any say in what happens. The interesting thing is that when people play this game, they don't always offer 100-0. Sometimes they do, but they don't always do that. Sometimes they offer a fair split, 50-50, sometimes they offer a bit different to that. But the interesting thing about this study is that if you introduce a third person who finds me, if they think what I'm doing to Tom is unfair, the rational expectations thing to do is for me to lift the offers that I make to him. But what often happens, or what sometimes happens, is that I reduce the offers I make. And it's the same argument. The introduction of a financial incentive takes away whatever generosity I had towards Tom, and suddenly I think, okay, this is a market business, this is all about money, what's the best I can do? I'll offer 100-0 and take whatever fine comes my way. Fortunately, I can not just speak generally. There does seem to have been something that's happened to bankers, at least based on one study. So I said motivation crowding out seemed to be a general phenomenon, but it is arguable that it's happened in banking in particular. So let me tell you about a lovely study. I really like this one. There are 100 bankers randomly assigned into two groups. Before we go into the groups, I'll just tell you what the experiment was. Very simple one. The people in the two groups would simply flip a coin 10 times and report the number of heads. And every head they reported, they'd get $20. I think it was dollars, it might be euros, I'm not sure. They'd get 20 currency units. Now, the thing was that their flipping of the coins happened in a private place. No one could see them. So the obvious incentive is to cheat and say you've reported more coins, more heads than you actually got. And the beauty of the experiment is that while it's impossible to observe and penalise individual cheating, when you get back the answers from lots of people, you can see from the distributions whether there's been cheating. So here's another clever thing about the experiment. They split into two groups. Remember, these are all bankers. One group of bankers over here, they were asked questions about what they did in their leisure time, their non-professional identity. What's your favourite activity in your leisure time? They were put into a home mindset. Then the bankers over here were put into another group, and they were encouraged to think and talk about their work. What's your position in the bank? What do you do? Describe your banking job. So they were in a work mindset. And of interest is whether the proportion of heads that were reported in the two groups, whether the group that had the professional identity of bankers reported more heads than they ought to have. So let me go through these. The left-hand panel is the control group, the right-hand panel is the professional identity group. The blue bars are what you expect if people are reporting truthfully. Now, in the left group, this is the control group, there is a little bit of cheating. You'll notice that although a small fraction of people would have been unfortunate enough to only get one head and earn $20, they didn't admit to that. And although it's virtually impossible for people to have got 10 heads, some did say that and got paid for it. So there was a little bit of cheating going on. But have a look at the bankers. Sorry, they're all bankers, I beg your pardon. Have a look at the bankers in their role. The left-hand panel is the bankers at home. The right-hand panel is the bankers in their role. In the right-hand panel, you get quite a few people reporting that they've had 10 heads when that's very, very unlikely. And you get the whole distribution shifting up, so there's a significant difference. What's going on here? Is this just a difference between work and home? Is it a difference between talking about finances and not? They tested that. So is it a difference between work and home? They tried it for other professions and it didn't work. There was no difference in those two distributions. Is it a difference between talking about money and finances and not? No, they tried university students, talked to one a lot about their leisure activities, talked to another a lot about their finances, and it didn't make any difference. So insofar as this goes, it's evidence that bankers in their role are less honest. All right. It was not always like this in the era of the gentleman bankers. I apologise, this is a non-inclusive term again, but it's one that was used. Banking was once a gentleman's club where the members monitored themselves and were very risk-averse. Firms and partnerships that were not fit and proper suffered penalties and even exclusion from the club. They had a lot to be proud of. They had financed the empire. The city had supported the economy for centuries and could boast the following achievements by the early 20th century. They had run worldwide sterling payments mechanisms, attracted and invested funds, developed markets for securities, derivatives and commodities, and financed many projects worldwide. A particular note is Lloyd's in the insurance space. The company was formed in 1688. Its high point was the very prompt and generous and effective financing after the San Francisco earthquake in 1906. The low point was the monopoly on the slave trade insurance, but there you are. They've been around for a long time doing a lot of things. What was banking doing in the immediate post-World War II period in the so-called Attlee era? This is the Attlee government's building of the welfare state in the UK. Well, banking was pretty static. Strictly regulated markets, international movements of financial capital limited and highly fragmented. As I said before, the participants had to behave well, and there was good behaviour exemplified. David mentioned the example of Warburg's as a company that exemplified good behaviour during this period. There were 5 silos of finance, and only the 5th one, investment or merchant banks, took risks, but they took risks largely with their own money, and so they didn't have the same appetite for risk that we've seen recently. The bankers themselves were boring. So a typical 1960s, I hope no one here was a bank manager in the 1960s, can I just check that? Typical 1960s bank manager were conservative. They only lent to borrowers who were very, very likely to repay their money. They had a personal relationship, an ongoing relationship with their clients, so that they might even regard them as friends, helping their families and their business to achieve their personal financial goals. Very little cross-selling, and conflicts of interest were resolved as a matter of personal integrity. They had low remuneration and no performance-related pay, and if you believe the Beatles, they never wore a Mac. The Bank of England presided over this situation largely by moral suasion. They had a few penalties up their sleeves, but there was even a superintendent of the Bank of Scotland who would visit all the branches. I find that scary, even the thought of the Bank of Scotland superintendent visiting me. So it was a system run by moral suasion and the cooperation of the banking sector. It did have to come to an end because there was excess demand for finance by many creditworthy customers, and 3 proximate factors were its undoing. General economic growth and democratisation of banking. The increase in home ownership in the UK was very important, and the instance of private superannuation. So the whole setup was loosened up, and in 1986 there was a substantial redesign of the financial system with the so-called Big Bang reforms. Now, market-based approaches to finance were warranted, and it led to a greater access by creditworthy customers, but it's worth asking if something was lost. Now, for the people in this room, I don't think there's any need to go through in laborious detail about all the kinds of things that went wrong in recent years in banking. I just want to focus on this issue of motivation crowding out in banks. Many of you would have heard of or read Michael Sandel's book, What Money Can't Buy. It's a critique of how marketisation changes things. But that stands in the place of a sort of long philosophical critique of what you might call utility maximising moral calculus, and Bernard Williams is somebody who's written in this. I'll just let you read something he wrote. This is about making a moral decision using utility maximisation as a framework. Okay, I take that and similar text of his to be saying that the gist of it is that some courses of action should be unthinkable in the moral realm, and that's actually an old idea going at least back to Durkheim and Gooden, but it goes back further, I suggest. And I'm going to give you an example now of something that you might think is unthinkable, if that makes sense. You mightn't agree with the particular example I'm going to give you, but perhaps you can think of other examples of courses of action which, if they're put before you, you might say, well, I'm not going to do a cost-benefit analysis, I'm just not even going to think about that, I'm going to go this way. So the example I'm going to give you is Wells Fargo. They've recently been fined $185 million for opening fake accounts to boost sales. They fired 5,300 employees, and I just want to say I checked that on the internet a number of times. I thought it must be a typo. That's a lot of people to fire in a very widespread practice. And these people were opening fake accounts and pretending that they were real so they could boost their sales figures. They neither admitted nor denied the wrongdoing but paid the fine. That's lovely, isn't it? Neither admitted or denied. The question is, how could the management of such a firm fail to resign immediately as a matter of moral principle? Well, I think it's only by doing an instrumental sort of calculation and deciding you can write it out. And according to Williams, the calculation itself is a reprehensible moral act, even if they'd ended up resigning. Even if they'd resigned, it was the wrong thing to do to consider the possibility of not resigning, according to Williams, according to that line of thought. So the calculation we're talking about here is a sort of cost-benefit thinking applied to morality. And many people in finance have had an economics training, which does encourage the idea that everything boils down to a cost-benefit calculation. So maybe I'm partly responsible for the global financial crisis. Let's not just talk about the supply side here, let's talk about the demand for finance as well. Sandor writes, when we decide that certain goods may be bought and sold, we decide, at least implicitly, that it's appropriate to treat them as commodities and instruments of profit and use. So let me ask you, is your right to trustworthiness, when you deal with a bank, you presumably have a right that they'll deal fairly and squarely with everybody else, is your right to trustworthiness being sold to your fund manager when you get a high return from risk-loving banks?
Could you explain the meaning of that question? It's a complex question.
Yes, perhaps I could have worded it a little better. I'm just saying that when you decide that you will you invest money with a bank that takes a lot of risk and you receive a high return for it, maybe the risk they're taking is actually through improper behaviour. And so you've actually sold them the right that you have a right to expect them to treat others fairly, and maybe you've sold them that right and received some money in return. Maybe this slide will make it a bit clearer, David. We all know that rights to pollute are sometimes traded. So if you earn high returns from a dubious fund, maybe that's like them buying from you a right to be a rogue. So you sell them a character destruction certificate and they give you money for it. And then they can do whatever they like with their clients, and you earn a handsome return as a result. If that's right, then what we traditionally think of as a risk-return trade-off, maybe a more complex trade-off. When you take out highly risky investments or encourage your banker to do so, maybe what you're doing actually is not just encouraging them to take high risk, you're encouraging them to play fast and loose in whatever they're doing. Now, what you think about that, it really depends on your ideas about economics, I guess. If you think that the problem is externalities, then you would say that trading in rogue rights is okay. Just as environmental economists say that some pollution is optimal, and so you trade in it to just get the efficient allocation. You might say there's an optimal amount of roguery out there, and we just want to get the efficient allocation. So if it's morally okay, once externalities are taken into account, you would just settle at an optimal amount. Or you could say, no, banks shouldn't behave in certain ways as a matter of principle. And it's quite a different approach. There are different ways of thinking about things. So let me now look at this question. There appears to have been a change in banking from, I don't want to call them the good old days, but certainly the different old days. There seems to have been a change from then to the modern era. So what I want to talk now about is whether that moral restraint that was lost was costly. Whether moral restraint that was in practice then is costly. So let's do a case study of a monopolist who doesn't maximise profits. The Gentlemen Bankers Club was an oligopoly that exploited market power, but probably not to the same extent as the current generation of bankers, or the very recent generation of bankers. So I'm going to describe the club as a monopolist that shows restraint by choosing the competitive equilibrium. That's an exaggeration. In the paper we have an oligopoly that goes a little bit more towards the competitive equilibrium, so it's more nuanced. But just for the purposes of this presentation, I'm going to make it really stark, going from monopoly to a perfectly competitive outcome. And this helps us think about moral restraint and how we might think about that in economic analysis. So, a little bit of economics here. We've got a loanable funds theory. There's a downward sloping demand for loans. Horizontal supply curve because banks can attract funds at a constant interest rate from the public. The monopoly equilibrium is up at point A, and the competitive equilibrium where supply equals demand is at point B. Profits are just the same as producer surplus. There's no fixed costs, so those two things become equivalent. And consumer surplus is the area underneath the demand curve and above the price. And the way that I've drawn that diagram there, the big triangle, actually I wish I had a pointer, but the triangle above the marginal cost line, the one that includes A and goes right up to the top axis, whenever the amount of loans changes, you're just shuffling consumer surplus, producer surplus and deadweight loss around and keeping the total amount of that fixed. And that implies that any gain, for example, in consumer surplus, if you imagine the price dropping and consumer surplus getting bigger, any gain in consumer surplus is just equal and opposite to the loss in the sum of producer surplus and deadweight loss. All right, now what I'm going to do now, I want to talk about a monopolist who chooses not to exercise monopoly power. In order to do that, I have to say something about the preferences of the monopolist. So I have to put I have to translate this diagram into a space where you've got PS and CS, producer surplus and consumer surplus, because I want to be able to talk about preferences over those two things. So I've got to turn this diagram, which is a classic supply and demand diagram, into a diagram which is about feasible sets of producer surplus and consumer surplus. So let's do that. I need to tell you a few things to do that. A is by definition the maximal value of profits, PS. If you go to B, profits are completely eliminated. So profits are maximum at A and minimum, namely 0, at B. Consumer surplus is always decreasing as the lending rate rises. So if you imagine restricting loans even further, so the price rises, consumer surplus will always go down. We can identify two regions relative to A which will help us draw our diagram. Region 1, imagine that you are a monopolist at A and you decide to produce at the competitive equilibrium at B. Because A is a maximum of producer surplus will fall as you go from A to B, and because prices are falling, consumer surplus will always rise. So in that movement, you will see a fall in producer surplus and a rise in consumer surplus. Region 2, imagine you're at point A and you restrict loans even further. Well, because the producer surplus is maximised today, moving the other way will see producer surplus fall, and because prices are rising, sorry, some of them say prices and some of them say the lending rate, you know what I mean? Because the lending rate is rising, consumer surplus will fall, and so going the other way, both producer surplus and consumer surplus will fall. Now I'm going to draw my diagram, and here it is. So region 1, remember that was saying as you move, so this diagram has producer surplus on one axis, consumer surplus on the other axis. This is a mapping of producer surplus as a function of consumer surplus, which is identical to the previous diagram based on the monopoly. So point A, you recall that I said that as you move from A to B, producer surplus falls from its maximum to 0 and consumer surplus rises. That's why it looks like that. The region 2, as the price or the lending rate rises above A, which actually in this diagram will be, imagine the point on the horizontal axis at the base of A and going that way, that will see both producer surplus and consumer surplus fall. So that's why the diagram looks the way that it does. It has a slope of -1 because any loss in consumer surplus, imagine going from B to the vertical line at A, has to exactly equal any loss in consumer surplus has to equal gain in producer surplus and deadweight loss. So that's why I've got a line there of -1. And now what I can do is put preferences overlaying that feasible set of consumer surplus and producer surplus. Look, if you've forgotten all this stuff since first year micro, it's just like the standard diagram. We've got a budget constraint and an indifference curve. What I've done up there is build the budget constraint. I've built the set of feasible trade-offs, and now I'm going to talk about the willingness to trade off. That's the indifference curves. All right. So before I say that, though, let me just make a comment that if the gentleman moved from a monopoly equilibrium to the competitive outcome, we all know that's good for efficiency because we all know that perfect competition is good for efficiency. But it also implies that the gentlemen were acting a bit like a stakeholder firm. Remember these two definitions? Shareholder value firm, if you ignore the complexities of going from profits to shareholders. Shareholder value firm might be a firm that only cares about profits. A stakeholder firm, in this context, would be a firm that cares both about profits and consumers in their own right. They don't just care about consumers because they help them maximise profits. They care about consumers in their own right. That's the distinction. So what I'm just going to do now is show you quickly that a gentleman banker that decides to go from exploiting whatever monopoly power they can to going to a competitive equilibrium, they're actually going to act as a stakeholder firm. We all know the competitive equilibrium is efficient, but what does efficiency imply? Well, if you like a bit of calculus, look at the left-hand side of that, and if you don't, just look at the right-hand side. That just says that if a firm chooses to operate at B, it's trading off producer surplus and consumer surplus 1 for 1. It's valuing them both equally. And that, you could say, is a stylised representation of having a stakeholder firm. Whereas a shareholder firm doesn't value consumers at all in their own right. It only values consumers as a means to maximise profit. Okay, well, this is a key slide. Let me now just talk you through how we think about policy, morality, and gentlemen bankers and those afterwards in this kind of discussion. So first of all, after the Big Bang, when we're talking about people doing the best they possibly can in terms of maximising profits, I'm just going to stylise that as having lexicographical preferences over profits. The preferences rise as you go up the diagram, and so clearly you just maximise profits. And that's my representation of how people have thought after the Big Bang. Prior to the Big Bang, if I stylise the gentleman as going from the monopoly equilibrium A to the perfectly competitive equilibrium B, I can describe that in two ways, which I think is a very interesting and important discussion, how we describe this. So the first way is the classic way in which Nobel Prize winner Gary Becker sought to describe altruism. What you say is that the bankers have preferences for the good of others. They have other regarding preferences, in this case the consumers. The indifference curve looks like that, and they go to B as a matter of optimisation. This is the classic way of describing altruism in economics, following Gary Becker's work in his treatise on the family. Now I'm going to raise some concerns about that with another Nobel Prize winner, and so whatever you think of what I'm about to say, whichever side you are, you can back it with a Nobel Prize winner. So this is a win-win for arguments, okay? David and I have some funny discussions about when we start to appeal to authority, we correct each other. You can't appeal to authority. The argument has to stand on its own. So I didn't mean what I just said. I didn't mean it. Okay, let's talk about some criticisms of this approach. So, now, Donald and I, a number of years ago, wrote a paper about how Becker's notions of altruism fared in the literature that followed his seminal work, the Treatise on the Family. Now, to summarise a lot of work, let me just try and do that quickly. Becker took altruism seriously. He regarded the family as a unit where people pooled income, where there were altruists who gave to each other. And it was recognisable as a well-functioning family. If you read it, you think, I can recognise this as a well-functioning family. Over time, that completely unravelled. What you have is you have agents sort of warring with each other in a completely self-interested way, and they're always looking at the outside option. They're always thinking, if this doesn't work, I'm getting out. It has to be utility maximising all the time, or that's it. So there was a constant cost-benefit calculation going on in these models as they developed after Becker. And so they basically didn't take Williams' advice. Remember what Williams said? To think about some things is itself a moral act. Well, the literature and the economics of the family just went down that path. Now, Donald and I wrote another paper. We're not Nobel Prize winners, by the way. We don't have any authority.
What a shame.
Donald and I wrote another paper about this where we tried to build another narrative on top of the sort of maths of utility maximisation. And our experience with this, so this is perhaps not so much a comment about logic but about the sociology of knowledge, is that economists really love simplicity. And so while everybody knows that narratives have to be built on top of the maths, they like the simplest possible narrative that there is. And selfishness and pursuing happiness is just simpler than altruism. It's just a simpler story. And so while I'm not saying this is logically necessary, it's my impression that that's why altruism runs into difficulties sometimes in modelling. Now, as evidence of this, I'm going to, as evidence of how people are attracted to simple narratives, I'm going to use Gary Becker himself as an example. This is a famous paper of his on an economic theory of addiction, why drug addiction is utility maximising. And whatever you think about that paper, he has a fascinating quote. I'll just let you read it for 30 seconds while I drink some water. Thanks.
Oh, that's crazy.
So what's going on here is that Becker is torn, I think. He puts rabbit ears around the happy because he knows that utility maximisation and maximising happiness shouldn't be the same thing in theory. But then in the rest of the quote, he can't help himself. He actually accepts that kind of use of the word utility maximisation. And I think that this is not uncommon. I think the fact that you use a certain style of analysis just drives people into a certain mode of thinking. So an alternative is a thoughtful paper by Sen, where he coins the term commitment as an alternative to utility maximisation, especially for moral issues. He says that people sometimes act for non-economistic reasons and that just simply overrules their utility maximising decisions. And he rejects the notion in mainstream economics that chosen and preferred are the same thing. He says the word preferences, which is what we use to describe people's attitudes to the world, confuses this, and he criticises it on those grounds. We can model what Sen is saying here. What about we don't say that the gentlemen have preferences over the good of others. We just say this. We say that they decided for some other reason than utility maximisation to move from A to B, and it cost them this much utility. So what we've done is we've taken Sen's advice, something else comes in and wipes over the utility maximising choice. We can use utility analysis to measure what the cost of that is. It's the utility difference between the red and the green line. If you don't like the idea of measuring utility, you can just measure it in terms of foregone producer surplus. You can measure it that way. Okay.
Before you go on, let me say one thing about that. I was very taken by the first paper this term, Thanasoulis and why can't I remember the
Morris? Was it Morris?
Alan Morrison, in which there was what is equivalent to a commitment outcome and a best for you outcome, and they had an overarching meta level, one level up utility function in which you could trade off.
Right.
And I was expecting you to go all the way to that. We could put convex indifference curves on that page that were tangent to the budget constraints, somewhere between A and B. And then we would be using the method of reasoning that Morrison and Thanasoulis were using in the first lecture. And I think that's quite an interesting way of connecting. A lot of that stuff that they said I thought was on a wrong track, but the fundamental idea was of this trade-off, and your...
Well, to be fair to Gordon, he did say at the beginning, I'm taking the two extreme
yeah, exactly. No,
positions.
I think I'm
in the
I'm
model
just
in the
trying
paper.
to say that you were, since you're not real, in the paper you don't go bang bang, you're in the middle.
Yeah.
I think I'm really just saying that when you're in the middle, that's exactly what we were listening to in the first
That's very
seminar
interesting.
this term.
That's very interesting.
Now
And I think they used it all the wrong way. There was all sorts of problems with that analysis.
There's
But
still
the
a
fundamental method of proceeding was like yours.
There's still a distinction to be made. Now, my filmer is going to hate me for this, so sorry about that. And I'll take the extra time at the end. There's still a distinction to be made, though, because what you could do is you could say, okay, I'm going to go here and pop myself there as a matter of utility maximisation.
Or something.
Or you could say, I'm just going to go down to there and measure the loss in utility, but keep those preferences the same. There's still the distinction to be made between Sen and Becker in that regard.
That's very good, and that's a, if you like, a Marcher Sen attack on the whole procedure of the first seminar this term, which is that's
right.
really that's
right.
really interesting.
Okay. Now, as policymakers, the great appeal of competition, going right back to Adam Smith, is that if you... Oh, I should back up a little bit. Neither Sen nor Becker are suggesting that everybody always acts like this all the time or anything. This could be a fringe phenomenon. They're not saying that this happens all the time. So as a policymaker, there's a dilemma that, how much do you rely on people's good motivations? How do you think about their good motivations? And this is the enormous attraction of competition policy, as we know. Faced with the situation where there's a monopolist today, if you just pile in lots of firms and competition works, you just get forced to be, and you don't have to worry about all this stuff about moral motivation. That just makes it all so easy. So, that is a appealing solution.
It's roughly John Vickers.
That's an appealing solution. I'll leave that comment till later. That's an appealing solution. So my conclusion to this section is the gentleman exercised some moral restraint. If we don't want to inculcate moral restraint in current bankers, competition policy is the standard economic way to create a system that's robust to people's motives. This is particularly germane for making motives about exploiting monopoly power irrelevant, which is the example that I've used. But I personally think it's also relevant for things like lying. If you have a lot of firms around and one firm has a reputation of being dishonest, that could be very dangerous for them, for the unrestrained firm. So although I've used the example of of monopoly power and competition, I think the same thing is also true for things like lying. So the natural question is, does competition policy work for banking? Because if we can make it work, we don't have to worry about this stuff very much. And that's my next point. So the operations of the invisible hand require many auxiliary assumptions. In theory, that's the Arrow-Debreu theorem, but in practice as well, there are two relevant ones here. The first one you might call the evolutionary argument for the invisible hand. You want to have badly performing firms and employees thrown out of the market. Now that's not really Arrow-Debreu. Arrow-Debreu is not dynamic. It doesn't have firms coming and going. It's a different idea. But in practice, this is a good argument for laissez-faire capitalism, that you want to have bad firms and employees leaving the market. And also you want the absence of monopoly power. That is in Arrow-Debreu. What I'm going to suggest, I'm going to be a little bit controversial and overstate my hand perhaps. Competition policy is hard for any industry, but competition policy in finance is especially hard because these two hurdles are not easily passed. Now you mightn't agree with this, and I think it'd be a really interesting conversation to have afterwards. You have a lot of expertise perhaps that I don't have. It'll be really interesting to see if we can get a room view on this one. But this is the line I'm just going to pursue to sort of test it out with you. So my first claim is that bad banks endure, and so do their employees. Often we think about the evolutionary argument for the invisible hand in terms of firms, but I don't think there's anything nonsensical in thinking about in terms of employees as well. I mean, think about the people who are fit for jail, who are still running financial firms and still doing lots of good stuff. Lots of bad stuff, really.
Bad stuff.
They're still there. So it's not just firms that you want to stop existing in the evolutionary argument for the invisible hand. You want people to leave as well. We all know that financial firms foist special risks on the economy, and in a crisis they can be too big to fail or too important to fail. And then governments are under enormous pressure to bail them out or just do loose monetary policy to ease the constraints on everybody. And historically, it's been the case that some employees fit for jail continue on in their roles. So my conclusion is that the evolutionary argument for the invisible hand in finance fails. Now, you might say, wait a minute, what about all the reforms since then? Well, it's very true that there have been some excellent regulatory reforms since the crisis, ring fencing, bail-ins and increased capital. These will reduce the probability of a crisis, but what's relevant here, which is about the evolutionary argument for competition, what's relevant here is that they won't limit they also limit creative destruction. By preserving the system from crises, which is a good thing, it does have the downside that it limits creative destruction. The second requirement was about monopoly power. Now I have to say that banking doesn't look too bad on this. These indexes on the side here, it's the Lerner index, which is the proportional markup of price over marginal cost. You might remember that diagram I showed you with the monopolist. Clearly the most competitive outcome when price was equal to marginal cost. Anything above that is a measure of lack of competitiveness. Now these numbers, some of them are quite big, ranging from 5 to 25% markups, but bear in mind that in the mid-20th century, a lot of US industries had Lerner indexes of 100%. So petroleum, textiles had markups of 100%. So banking is not too bad on this criteria, but it's not as simple as it looks. If you have a look at the US or Northern America, in the years leading up to the crisis, there was an enormous increase in measured competition. You see that line falling down quite a bit. That's the small dots. Now we know that you can call that increased competition if you like, but we know that it was accompanied by some really bad practices. As banks had their margins squeezed, they started to look for income in other things that were really, really bad. So even if you say that's greater competition, it's not particularly good. But anyway, look, banking doesn't look too bad on this criteria, but you wonder how it is that they can pay so much. So what this chart here is, it's a measure of the premium paid in banks to their employees. The one is the average weekly earnings, and the green line, which ranges from 1.5, goes down to almost 1, and then goes up to 1.3. That's a measure of what banks should pay. Now, all econometric estimates have their issues, as you know, but this one's based on two things. It's based on the probability of the bankers losing their jobs, and it's based on their education levels. So using those two as inputs, someone has measured that the green line is a sort of a justifiable return for the banker's wage. And as you can see, during periods of financial innovation, there's been a huge premium opened up, and you just have to ask yourself, if they're under serious competitive pressure, how do they pay these kinds of premia? It reminds me of, I think, David, it was John Mellor who was here a few weeks ago and said that the valuation of the assets can change how profitable banks look on paper, and I guess how they value assets can make them feel they're more profitable, and there's a possibility of self-fulfilling enthusiasm. We're doing so well, if I just change this little discount rate here or this provision here, we're doing so well I can afford to pay myself an enormous amount of money. So that's a bit of a question mark.
But just to say, that picture completely underlines the previous picture. If you go back to the previous picture, the previous picture says they're not making too much of a markup over costs, but the second picture shows the costs are out of control. So
oh yeah, that's an interesting point.
So that second picture just demolishes this first picture.
Yeah, good point.
In that first slide, what is that? That's just for finance or for all industries?
No, this is for finance. Sorry, I should have said this is banking.
They're all finance.
Yeah, that's
They
right.
just pay themselves.
Yeah, that's right.
Yeah, that's right.
Banking or all finance?
So what's your question?
I believe that's banking.
Because the learner index for banking, that's a fascinating calculation. How the heck do you do that on gross margins, on net?
Oh yes, the measurement problems are incredible.
Connected with my question.
Yeah, that's absolutely right. Yes.
Yeah.
Yes, that's right. So I remember trying to work out FISM for when I was at the RBA, just trying to work out how you work out bank output and therefore profitability. So you've got to estimate production functions, all sorts of crazy things.
My gut feel is that understates the learner,
Okay.
the learner index understates it from my own experience of
Okay.
excess returns in banking.
All right, thanks.
I think I was saying a sort of not very well worked out version of the same thing.
I think your point's a separate point, but it's a good point. Yeah. Okay. So how do we interpret profits anyway? This is very complicated. Remember I mentioned the carry trade, which was that way of earning a good steady stream of money, so it appears. If you're my clients, I'll just keep paying you money, but there's a huge risk that it'll just blow up at some point in time. Well, that stands as an instance of a whole range of strategies which are profitable in the short term by piling up risk in the tails. We all know that. No, I don't know how to pronounce this, David. Is it Noe or No?
No.
No and Peyton Young in David's book have some excellent examples of these strategies. And when the tail event happens, the investor loses everything, but the fund manager just shrugs their shoulders and fails to get their bonus. So profits are a very complex thing to interpret for banks because of the stretch of time over which all the transactions and all the outcomes of decisions will occur. It's a very long stretch of time and a lot of things can happen. So profits could be, I remember actually I was a banking analyst in the Reserve Bank quite a few years before the global financial crisis. I remember doing the releases for the bank profits in Australia. Australia has 4 big banks, they're always incredibly profitable. We used to complain all the time about how uncompetitive they were, but then when the global financial crisis hit and they never blinked, we just thought this is great. We were like Canada. So profits can be a sort of necessary buffer for a bank to withstand a crisis. They can be a good sign. They can be a sign of monopoly power. They can be the result of building up fat tails. It's really hard to know what to make of profits. And even if you're a regulator and you think you have good reason to be very concerned about bank profits or any other activity of the bank, you may choose to not pursue a complex competition case against a bank because it is so complex. This could lead to a higher bar of misbehaviour that triggers court action for banking vis-à-vis other industries. So if we're thinking about different forms of competition policy, whatever the law says, whatever principles and whatever specific legislation is laid down, whatever that says, put yourself in the shoes of a banking regulator. You have to decide whether it's worth taking these people with an incredibly complicated situation and incredibly good lawyers paid incredibly well. You have to decide whether it's worth taking them to court. And if you come to the conclusion that it's just a lot harder to take a bank to court, in practice, if not in law, there will be a higher bar for misbehaviour, and that leads to less competition. This may also help explain the lack of litigation against managers after 2008. Though that's a speculation. There may be a lot of political economy reasons for that as well, to do with lobbying of banks. So my conclusion, sadly, is that competition policy in banking doesn't work very well. It fails the evolutionary test for the invisible hand because bad firms and bad employees don't have to exit, and it's very difficult to get a grip on monopoly power. And so I think there is a lot of exercise of monopoly power in banking. Which leads to the conclusion, and because David's asked so many questions, I'm going to take an extra 5 minutes. Which leads to the question, so just to pull all this together, we don't appear to have available to us the standard economist's trick of not worrying about motives. The standard economist's trick of not having to worry about motives is to introduce competition policy. If we don't have that trick available to us, we do have to worry about motives because there's monopoly power there which can be exploited, and other kinds of exploitation is possible as well. So this leads us to try and address banker trustworthiness directly. And that leads to a fundamental question: is finance supposed to be a business or a profession? What do I mean by a profession? This is a little idealised, but a professional, that should be a profession actually. Professionals don't come into existence, it should be a profession. A profession exists to serve another person, or a professional aims to serve another person. Their telos, or their end goal, is supposed to be the good of the client, not their salary. David gave me an excellent article to read, Downey, who lists 5 features of professionals. Here they are. Specialist skills or knowledge base. When you think of most of the professional, you know, they have kind of complicated knowledge bases. The client is vulnerable and needs beneficence. Now, this is partly a result of the first point. If the professional holds a lot of knowledge that the client doesn't, there's a power imbalance, and you hope that the professional acts in the interests of the client, that the professional is well disposed or beneficent towards the client. Now, as Downey points out very nicely, the pathology of beneficence is paternalism, and so how do you avoid paternalism? He says that this beneficence has to be exercised with honesty and justice, what he calls integrity. Professional is supposed to have an authoritative public voice. Why is this necessary? Again, it goes back to point 1, because it's so complicated to understand the issues. You need to have someone who can speak, who knows about the issues. They should be independent of sectoral or other interests, and they should be well educated beyond their narrow field. And we would add that, I attribute this to Tom actually, we would add that what they provide has to have critical, practical value. Why I say that is because I'm a chess player. It's a very specialised thing. If I was teaching people to play chess, I could fulfil most of those criteria, but I don't think it really matters very much, and I wouldn't mind not being called a professional chess educator. On the critical practical value, we'll go to that one first. It does appear that finance has critical practical value, though I admit that depends upon the societal choice for the provision of housing and the pension system. If we lived in a society where the government provided the housing, the government provided all the pensions, then maybe you could say, well, if people want to play and gamble with their money, it doesn't matter, and it doesn't matter if the financial system blows up. But in the West, we use banks for both of these, and so it does matter if the financial system blows up. On the specialist skills and knowledge, finance practitioners generally do know a lot more than their clients. They have the specialist skills, the clients are vulnerable, and so points 1 and 2 follow, and perhaps point 3 as well. Points 4 and 5, I don't think it is fair to say that the finance sector is independent of interest other than their clients. And the risk of being controversial, I'm not sure they are well educated beyond their narrow fields. So my conclusion is that finance needs to be professionalised. How to do this? Well, being an economist, of course, I have to go to economic forces first. Labour markets will do part of the job. With the regulation since the big bust, finance is probably less profitable and maybe less mathematically interesting. So people who join it mightn't be quite as financially motivated, and they mightn't have such extreme quantitative skills. And if these features of the people who join banking are, if those features are negatively correlated with soft concepts associated with professionalisation, then maybe that will change the culture and pave the way for professionalisation. We have examples of professionalisation already with us, so the General Medical Council. Now let me just say something about this quickly. I'm nearly at the end here. Let me just say something about this. The advantage of self-certification.
Take your time, people do run over in this sector, and we've got it longer it's a longer time. Go on.
Okay. An advantage of self-certification is that whilst a legal path to remove someone from practice can be very difficult, very complex and very long, if there's a professional association, say in the case of doctors, they can stop someone practicing pretty quickly, and the onus of proof is really on the doctor to sort of prove that they're innocent for the purposes of stopping them practicing. Now what happens later, what works out legally, and what the final outcome can be a very long thing, but at least they can be stopped doing damage straight away. There is, to my knowledge, no similar kind of body that deals with finance, and maybe there should be. Maybe there should be people, as it were, suspended quickly on the basis of what appears to be malpractice until an investigation works out. Economists won't like this second point, but it's worth saying that maybe non-performance related pay signals trust. So one of the criticisms that people make about performance-related pay is it sends a signal, A, that all we care about is money, and B, we don't trust you. We know that if we don't highly incentivise you, you'll be lazy and won't do what you're supposed to do. So it sends a powerful signal to people that the management is treating, or the people paying the person are treating them in a fairly mercenary way with fairly low expectations, and they don't trust them, and that may affect the person. That may affect the way that they go about things. Oaths of service are possible. I don't know much about this. The little bit that I have read about it is that it's been tried in some countries and there's no evidence either way about what it does. It may be that trying to invoke a kind of service ethic is more helpful in banking than appealing to esteem. Esteem is a powerful force for people. They want to be esteemed both within their professions and outside. But as Pettit notes, most people don't like it to be known within their organisation that they work hard for esteem. And so this it makes it kind of complex thing to implement.
That's just value of limits.
Take that off the film, Okay, finally, and I guess this interests me as an educator, there is the possibility of using education to try and change the culture. So ethics education for the feeder disciplines, and actually I should have said ethics education within the organisations, I forgot to say that. Ethics education for the feeder disciplines, including economics, is another path for professionalisation. Now this can take two forms. One form, which I think is relatively easy to digest, but if you think hard about it you can criticise it a lot, is just to say to people, well, here are some professional standards that you should meet, or some ethical principles you should have, and let's give you a situation that's relevant to those ethical standards. So imagine you're in a bank, somebody rings up and they tell you one thing, somebody else rings up and they tell you something, and you're supposed to be disinterested with respect to both of them, but there's a way of making money from sort of trading one off against the other. What should you do? And then people can kind of be seen to recognise how a moral principle might apply in a certain environment. So I think that's a fairly easy to disseminate way of doing things. But what it leaves untouched is the kind of deep underlying way of thinking in professions. And people might just be a bit cynical about it and not take it very seriously. So another more challenging task is to try and uncover the corrosive elements, I mean morally corrosive here, the corrosive elements of the feeder disciplines training. In a little bit of the same way that I've tried to talk about how economics can sometimes provide perhaps unhelpful ways of thinking about ethics in this presentation, one could try and teach that to students and try and get them to think more deeply about whether their training itself predisposes them to think a certain way or be susceptible to motivational crowding out. Now, why would I make the claim? That has an implicit claim there that people who study economics are sort of more susceptible to being motivationally compromised. There is evidence that people who study economics are less cooperative and more selfish, at least as measured by responses in games, than other students. There's a lot of debate about whether that's a self-selection thing or whether it's actually a training thing, and the consensus seems to be that it's a bit of both. So to the extent, now I personally find it easy to believe that there is some training element, there is some actual effect of the training, but that's something that we can talk about, and it's probably based on my own experience as much as anything else. Okay, so we'd just like to make the following argument, that it is costly to go from a situation where you have people who are fit and proper, or who look at each other and try and get themselves to behave ethically. It's costly to go from that situation to a situation where people are essentially out to maximise profits and do everything they can and out for themselves. That does have a cost. Applying competition policy to make all that irrelevant is difficult. That's the second point we'd like to make. And so that seems to open up a space or open up a requirement to address banker trustworthiness directly, as difficult as that may be.
Thank you very much.